Warren Buffett, 3 fast ways to compound your money. Hey there fellow investors and tech enthusiasts, welcome back to another exciting episode of our YouTube channel. Were you aware that Berkshire Hathaway, led by Warren Buffett, achieved an impressive annual growth rate of 20.3% from 1965 to 2020? Furthermore, Buffett transformed a struggling textile mill into a $700 billion company. These remarkable statistics go beyond mere figures, they illustrate Buffett's astuteness as an investor. Today, we aim to tap into that wisdom by guiding you through a strategy inspired by Buffett, potentially increasing your investment from $10,000 to $100,000 in a few years. We'll explore how disciplined investing can turn what may seem almost impossible into a reality over time. Investing, contrary to popular belief, is not overly complex, its basic framework is straightforward. However, it requires effort on your part. Let's delve into the fundamental aspect of Warren Buffett's investment strategy, saving and investing wisely. Buffett, renowned for his prudent financial habits, underscores the significance of saving as the initial step towards successful investing. His famous advice is not to save what remains after spending, but to spend what remains after saving. Suppose you begin with $10,000 and manage to save an additional $500 monthly. In a year, you'll have saved $6,000. Over 3 years, that accumulates to an extra $18,000, resulting in a total of $28,000 without factoring in any investment returns. Now, let's apply Buffett's investment principle to these savings. If you invest this amount in a diversified portfolio with an average annual return of 7%, a realistic figure based on historical market performance, your investment will grow each year. For instance, your $10,000 investment rises to $10,700 in the first year. Combining this with your yearly savings, you begin the second year with $16,700. Through consistent saving and investing, your initial $10,000 has the potential to grow significantly over a few years. Buffett's approach goes beyond wealth accumulation, it emphasizes financial discipline. He advocates for living within your means and investing the surplus. Adhering to this savings and investing plan is crucial for attaining substantial returns on your money. Additionally, Buffett underscores the importance of being well informed about your investments. Saving and investing alone are insufficient, understanding where and how to invest is essential. This entails conducting research, whether in stocks, bonds, or mutual funds, and making informed decisions. After establishing a solid foundation through savings, the subsequent step in Warren Buffett's strategy is intelligent and informed investing. It involves logical thinking, as Buffett suggests having the courage of your convictions and being willing to take action when others are hesitant. Buffett's success is largely attributed to his ability to select stocks that not only offer good returns but exhibit phenomenal growth over time. To incorporate this into your investment journey, Buffett advocates studying and understanding the market extensively. Look for companies with a competitive advantage, strong leadership, and a proven track record of profitability. Take, for instance, when Warren Buffett initiated the purchase of Coca-Cola shares in 1988, his attention was on the company's robust brand and global market presence. Presently, Coca-Cola stands as a prime example of a successful long-term investment, with its stock price multiplying several times over the decades. To incorporate Buffett's principles, start by researching companies with long-term growth potential, examining their financial health, market position, and growth prospects. Consider, for instance, a company with a stock price of $50 and an annual growth rate of 10%. A $5,000 investment in such a stock would grow to $5,500 in the first year. Buffett's investment strategy places significant emphasis on the power of compound interest. By reinvesting investment returns, he substantially increased the value of his initial capital. Illustratively, if a $5,000 investment grows at 10% annually, reinvesting returns could result in the investment being worth over $12,968 in 10 years, highlighting the potency of compound interest over time. Buffett's recognition of the value of diversification is evident in his investment approach. By distributing investments across different sectors and asset classes, you mitigate risk and ensure a more stable return on investments. This means, for example, diversifying your portfolio across tech stocks, consumer goods, and healthcare to avoid dependence on a single sector's performance. Buffett's approach also involves prudent risk management, steering clear of investments he doesn't comprehend and maintaining a balanced portfolio. Now, armed with $28,000 in savings and an aspiration for substantial growth over the next 3 years, let's assess the potential outcomes. Assuming a 10% average growth rate in a diversified portfolio with annual savings added, the investment grows steadily. In the first year, starting with $28,000, a 10% growth rate leads to an end-of-year total of $30,800. Progressing into the second year, an additional $6,000 in savings boosts the investment to $36,800, achieving another 10% growth and reaching $40,480 by year-end. Continuing this strategy into the third year, the total investment grows to $51,128, showcasing the power of consistent saving and investing. However, the market's unpredictability should be acknowledged. In a downturn, returns may be lower, while a booming market may yield higher returns. The process is not just about numbers but adapting to market changes and understanding the significance of diversification to offset fluctuations. Additionally, inflation must be considered, as nominal returns may not reflect real value without accounting for inflation. Moving to the third crucial part of Warren Buffett's plan, leveraging the power of compound interest, Buffett attributes a significant portion of his wealth to this financial phenomenon. Compound interest results from reinvesting earnings, leading to exponential growth over time. If you continue reinvesting earnings with a consistent 10% annual return, the investment accelerates its growth significantly, exemplified by the compounding effect. Buffett's strategy involves not only seeking good returns but also opportunities to reinvest those returns to generate more wealth, such as reinvesting dividends from stocks, profits from business ventures, or interest from bonds. However, it's essential to note that these calculations presume a consistent return rate, which may not always align with real-world market conditions. Diversification, as previously discussed, serves as a risk management tool in such scenarios. As we delve into the fourth step in Buffett's approach, diversification, it emphasizes the vital concept of not putting all your eggs in one basket. Despite Buffett's notable bets on companies like Coca-Cola and Apple, he underscores the importance of spreading investments across various assets to reduce risk and ensure more stable returns. Incorporating patience and long-term thinking into your investment strategy is crucial for aligning with Warren Buffett's approach to financial success. Here are some key considerations. Stick to your plan. Develop a well-thought-out investment plan that aligns with your financial goals and risk tolerance. Once you have established this plan, stick to it even during market fluctuations. Avoid making impulsive decisions based on short-term market movements. Resist emotional reactions. Markets can be unpredictable, and short-term fluctuations are inevitable. Resist the urge to react emotionally to daily market changes. Buffett advises against letting short-term market trends dictate your investment decisions. Focus on long-term growth. Buffett's success is attributed to his ability to identify companies with long-term growth potential. Similarly, prioritize investments that you believe will perform well over an extended period. Look for assets with intrinsic value that can appreciate over time. Reinvest returns. Buffett's strategy involves reinvesting returns to harness the power of compound interest. Consistently reinvesting dividends or profits back into your portfolio can significantly accelerate its growth over the long term. Diversify wisely. Diversification is a key element of risk management. Allocate your investments across different asset classes to balance your portfolio's performance. This strategy helps mitigate the impact of market downturns on your overall wealth. Regularly review and adjust. While maintaining a long-term perspective, it's essential to periodically review your investment portfolio. Assess whether it aligns with your goals and make adjustments as needed. This could involve rebalancing your portfolio or reallocating assets based on changing market conditions. Understand intrinsic value. Consider the intrinsic value of your investments. Understand the cash inflows and outflows over the long term. Buffett's method involves discounting future cash flows to determine intrinsic value. While you may not need to go to such extremes, having a solid understanding of the value your investments bring over time can guide your decision-making. Educate yourself. Continuously educate yourself about the market, investment opportunities, and economic trends. Being well-informed allows you to make confident, rational decisions and fosters a deeper understanding of the long-term potential of your investments. Remember that building wealth takes time, and success in investing is often measured over the long term. By incorporating these principles into your investment strategy, you can increase your chances of achieving sustained growth and reaching your financial goals. And that's it. We hope you enjoyed this video. Don't forget to hit like and subscribe to our channel for more updates. Thank you for joining us in this video, and we hope to see you in the next one. Happy investing!